welcome to Global Mantra Outlook 2014, a special show where we profile prominent fund managers from the City of London and get their views on the global market environment. Joining me on the show today is Nick Irish, who's giving his first interview to India. He's, of course, head of global equities at UBS Global Asset Management. Nick and his team oversee $13 billion in overall equities. Nick, thanks very much for taking out the time.
Nice to be here.
So what's the call that you're making for 2014 when it comes to equity valuations across the globe?
Well, I think equities still look reasonably priced versus other asset classes. And I think despite the fact we've seen a good run from equities since the low levels of early 2009, I think as we go into 2014, equities can continue to perform reasonably well, less well than they have in 2013, but I still think you could see a return of high single digits as the re-rating that we've seen across global equity markets is replaced by earnings growth as we move into next year.
But do you see earnings growth kicking in? Because what we've seen in the US so far is that there's been this big liquidity push which has driven markets. There is an expectation that the earnings cycle will pick up. Do you think that will happen in 2014, and if so, when?
I think we're on the cusp of that, and I think unusually in terms of the last 2 or 3 years, 2014 may actually be a year when earnings surprise on the upside. So for the last 3 or 4 years, we've seen earnings downgrades throughout the course of the year, even for US companies, and the US has been by far the most buoyant economy from a macroeconomic perspective. So I do think we'll see earnings start to pick up next year, led by the US, but increasingly with Europe and other regions to follow. And on a global basis, Japan is going to have very strong earnings growth as we go into 2014, some 30 or 40% for the market as a whole. And that's already baked in, driven by a weaker yen.
Okay, let's talk about US equities. I mean, it's been a great 2012 for US equities, great 2013. What does 2014 hold for the market? Because there is, of course, a broad expectation that valuations are at sky-high levels and the market should be bracing itself for a correction.
I'm not sure about sky-high levels, but the US equity market as a whole does look one of the more expensive to us. So we've had an underweight position to US equities over the course of this year, and that's really driven by the fact that we find it harder to find cheap companies in the US, and we're finding more of them elsewhere in the world. I think the market can go higher, but it has to be driven by earnings growth. So I think it all really comes down to the outlook for earnings. I don't think we're going to see any more re-rating of the US market, because to your point, it does look relatively expensive.
Well, but when you hear about opinion on the street talking about 15% correction from these levels for the US markets, do you think that the market warrants such a big correction, such a big adjustment in prices?
I'm not sure what's going to bring about such a correction. Most of the economic data continues to be in the right direction. Corporate earnings, certainly those released for Q3, have been broadly pretty good. You've seen a significant number of companies both beat expectations and raise guidance for the full year. So I struggle to see in the short term what the catalyst for a pullback might be. It could be the debates about the debt ceiling and the federal budget, which we're going to come into in January, and maybe that's the catalyst. But notwithstanding that, I think markets look reasonably well supported.
Okay, when you're talking about earnings growth in the US, earnings growth, right? I mean, we've seen good profits come in from companies, but the revenue growth has not really kicked in so far. So the broad, again, opinion on the street is once investments start coming in to the economy, once companies start making capital investments, that earnings will kickstart. Now, which quarter do you see that happening in?
Oh, I'm not clever enough to know exactly which quarter. I mean, it's certainly true that we've been waiting for a capex recovery in the US, and it has been a long time coming. I think we would have expected it to start this year. There are some signs that it has in some industries, but it certainly hasn't been widespread. So that's within our expectations for 2014, but I'm not quite sure when that'll be.
Do you think the market has priced in some bit of the recovery? Where do the markets stand from a valuation versus growth perspective?
I think the market is certainly anticipating earnings growth accelerating into 2014. That's why we've seen the re-rating that we have. Now, I think that's going to come about, but if it doesn't, then that could be the catalyst for a more significant correction.
So to that extent, do you think that 2014 could be a year of surprises, so to speak? Because if earnings growth kicks in, then the market could be at an inflection point and move higher from here. But if there is some sort of disappointment on the macro side with the debt ceiling issue or on tapering, then the market could go down. So we're pretty much, at this crossroads, so to speak, for the US market.
I think we're always at crossroads, and whenever you look back on any year, you can always identify events that cause markets to go one way or the other. So 2014 doesn't feel that different to me to most other years, to be honest.
Let's talk about Europe. What is the optimism in Europe suggesting to you?
Well, I think it's a couple of things. I think on the one hand, people are no longer worried about the stability of the euro as the common currency for Europe. So I think risk premia have come down as a result of that level of investor comfort in the integrity of the eurozone, which I think is absolutely right. And the second factor is that there's an anticipation of much faster earnings growth in Europe than we've seen in the US. If you look at US earnings, they're some 15% above the 2007 peak. In the Eurozone, or in Europe as a whole, earnings are 40% below the 2007 peak. So there's a lot of scope for earnings recovery within Europe. And as GDP growth has stabilized over the course of this year, expectations are that we might see one and a bit of GDP growth in the Eurozone next year. That should be the catalyst for an earnings recovery. And we should start to see significant operational leverage in Europe, which we haven't really seen in the US.
And do you think that'll happen in 2014, where again companies will start investing after deleveraging or cleaning up their balance sheets?
I'm not sure we're going to see a capex recovery in Europe next year. That's probably a story for 2015. But what we should see is a much faster earnings growth in Europe than that which the US is likely to achieve.
And that earnings growth will be driven by?
Driven by the top line. So let's say you've got nominal GDP growth of 3 or 4. You could see companies growing top line at mid-single digits, and significant operating leverage driving earnings at 2 or 3 times that rate.
So if you were to kind of understand the rally right now that we're seeing in Europe, would you say it's more a rebound given the kind of slam dunk these markets witnessed during the crisis, or is it that the market is pricing in the bottom to the crisis, so to speak?
I think the crisis is behind us in Europe, and I think that's exactly what's been reflected in equity market valuations. So what we've seen is a bounce back from very low levels of valuation. It's been focused on particular sectors, in particular financials. Most of the rally's really been driven by financials, and other more cyclical parts of the market have not really benefited. So, mining equipment, for example, has continued to perform poorly. So I do think it's a rebound from depressed levels of valuation in the expectation that the euro stays together and we see a more normal business cycle in Europe in 2014 and beyond.
But when you say normal business cycle, Nick, I mean, what would be the characteristics of that normal business cycle? Because it's not like deleveraging has completely happened in the Europe. We're in the process of deleveraging right now. You have an S&P coming out and saying that we're going to downgrade France again. And then, you have the ECB cutting rates to still give an impetus to growth. So it's not like we're done with, the monetary easing part of policy making either. So what is going to kind of characterize?
Europe's actually had quite tight monetary policy for most of this year. Most of the peripheral banks in Europe have been paying back their LTRO debt to the ECB. So you've actually had fiscal tightening for most of the year. So I don't think it's a great surprise that the ECB would seek to reverse that and inject some more liquidity into the Eurozone. I think that's absolutely the right thing to do. The other point I'd make is that within the more troubled parts of Europe, you have actually seen significant structural reforms, labour market reforms, internal devaluations have taken place, which does make those countries more competitive. I'm talking particularly about Spain, about Portugal, about Ireland, and to some extent Italy. And you've started to see their economies recovering on the back of that. We saw a positive retail sales number in Spain for the month of September. I think that was the first positive retail sales number for 4 years. So it is being reflected on the ground in terms of what people are doing. I think we could see, as we've seen in the UK, the savings rate come down to prompt spending rather than a significant increase in wage growth.
So what does that mean for the euro as a currency? Do you see strength there? Where do you in fact see more strength, the dollar or the euro?
I think in terms of the rate tightening cycle, the US is clearly far further along the road. So my guess would be that the dollar will be the strengthening currency over the course of 2014.
Do you think that 2014 could be for Europe what 2013 was for the US?
Yeah, absolutely. I think Europe is probably a bit further behind than that. I think the US is leading the way. You've got the UK, where the economy is already rebounding quite nicely. So the UK may be 9 months behind the US, and the Eurozone may be a year behind the UK.
What happens to emerging market equities then? And as somebody who looks at global equity markets, how do you look at the EM versus DM trade?
I mean, it has been a remarkable year in terms of the divergent performance between developed markets and emerging markets. I can't remember a time in my career when developed markets have gone up and emerging markets down. So certainly not within the space of 11 months. So we have seen a fairly extraordinary phenomenon, and I think to some extent that's been justified. A couple of things have been happening within emerging markets. First of all, GDP growth has been slowing. So whilst there's still a growth premium over developed markets, that premium is lessening. But what's, I think, more significant is that emerging market companies are growing their earnings less quickly than developed market companies. You've seen for the last 2 years or so that the margins for emerging market companies have been coming down, asset turnover has been coming down, they've lost some of their labour market competitiveness. And as that's happened, I think it's absolutely right that those markets have been derated.
Do you think that the derating could continue? We could see more downgrades in earnings and growth?
I think we're probably towards the end of that process. In terms of downgrades, I think even within emerging markets, it's quite interesting to see the divergence in valuation. So the parts of emerging markets, the sectors in emerging markets which are more structurally challenged, so the materials companies, some of the financials companies are trading on very low valuations, and they do start to look quite interesting, albeit they do have some challenges. Whereas at the other end of the spectrum, you have the consumer stocks which are trading on as high valuations as they ever have done relative to either emerging markets or developed markets.
Where do you think money would go into in 2014? Where do you see money finding its way?
I think over the course of 2013, there were perhaps expectations that you'd see money come out of emerging markets. I don't really think that's happened to any great extent. I just think the inflows have stopped. And I suspect that what we'll see moving forwards is money being allocated to developed markets over emerging markets. Whether that means you actually see selling in emerging markets, I'm not sure. Because I suspect you'll continue to see risk assets performing better, so money moving out of fixed income and into equities. But within equities, I think the preferred place will be developed markets.
So you're clearly seeing a shift from fixed income to equities in 2014, but you don't know. It's not clear as of now as to where within equities will the allocation.
I think it'll be developed markets rather than emerging. I think they will continue to garner the majority of flows as they have done over the course of this year, given the fact that the outlook for earnings is better in developed markets than it is in emerging.
So what's your outlook on currencies then? Are you going to be looking at emerging market currencies in the wake of a stronger dollar continue to see pressure, and thereby, from that perspective, manage your outlook on emerging markets?
I think most of the move on emerging market currencies is done, and you've seen quite significant policy action in terms of rising rates in a number of emerging markets, particularly those with current account deficits, to offset that potential issue. So yes, I do think the dollar will strengthen over the course of 2014, in particular against the yen, but also against the euro.
How are you going to be kind of devising your EM strategy for 2014?
I think it's difficult because the markets that we like the most for the long term, where we see the most opportunity for structural growth, are also those that are somewhat challenged in the short term. So the markets that we particularly like over the long term would be Indonesia, Thailand, India, but clearly they have current account problems right now. And those markets where we've seen some stability in the currency, some of the Northern Asian markets, in particular Taiwan and Korea, we struggle to find stocks that we want to buy. So we're in a bit of a quandary in between the short term and the long term.
But where are you allocating incremental assets to in 2014?
We're not yet putting more money to work in emerging markets. I still think it's too early.
For India specifically, given the current account deficit problem, do you think that 2014 is going to be an important year given elections?
I think it'll be critical, and I don't suspect we'll see very much in the way of policy action in the run-up to the elections. I think both sides will be focused on trying to win the elections, as is usually the case. But post that, then yes, I do think there's actually scope for more policy action, which could potentially ameliorate the current situation.
You're saying you're bullish on India long term, but you see a lot of policy headwinds right now. What do you need to see in India change for you to kind of change your rating on India? What is the rating right now, and where
So we're currently in our global funds we don't have any position in India currently. So we're starting from a position where it's easy to add. I think we need more political stability. I mean, it's easy to say, but it's been hard to achieve. As I say, I think over the long term the structural growth is there, but there remain significant headwinds of bureaucracy, political instability that seem to keep getting in the way of what should be a long-term growth story.
Do you think that post-elections there will be perhaps more clarity on taking a more directional call on India?
I think it depends on the result of the elections and whether we get a clear winner. Right now, it seems as though the race is pretty tight, and I think the more clarity we can get and the more decisive a victory, that would give us confidence that we're going to get more significant policy changes moving forwards.
Do you think in emerging markets there are opportunities now outside of the BRIC cluster? Because traditionally we've seen a lot within emerging markets. The BRIC cluster has essentially drawn a lot of the flows. Do you think that is going to be changing now?
Yes, and I think even within the BRIC cluster, I think it's wrong to talk about them all together, because they're in the individual economies of Brazil, Russia, India, and China have very different drivers, and that will persist over time. So one of the parts of emerging markets we are getting more positive on is Brazil, where they've been through a credit cycle that seems to be getting better. I'm going out there in a couple of weeks' time to meet a bunch of companies, because I do think it's one of the more interesting markets right now.
But given the outlook on commodities and the political scenario in Brazil, that would be a bit of a contrarian view, because most people are bearish on Brazil right now. Yeah,
and we're somewhat contrarian investors. I mean that's our style. I'm not terribly optimistic on commodities, but it's important to remember, whilst commodities make up a significant portion of the Brazilian stock market, they're not that important a driver of the underlying economy. I'd agree that the outlook for many industrial commodities is not terribly good as we go into 2014. So that wouldn't be the reason to invest in Brazil.
You don't see the cycle turning for commodities as well, because that's the other broad expectation, given what China is doing.
Well, I'm not. I think if you look at the economic fundamentals in most of the major commodities, whether it's iron ore or copper or met coal, we're actually seeing significant supply come on stream in 2014, and I think that's likely to keep a lid on prices. So our expectation would be that the iron ore price, which has actually held up much better than most people had anticipated, that the iron ore price will start to sell off in 2014, and that's likely to continue for a couple of years as we get closer to long-run marginal cost.
Talking about specific sectors within EMs that you do well, actually, you spoke about the fact that defensives, consumer names, pharmaceutical companies have done well across the globe.
Yes.
Is it time to book profits there and look at the cyclical stories, because you believe that growth could return and earnings could pick up from here?
Absolutely. I think within sectors that's exactly the call for it. It's been working for most of 2013, and I think that will continue to be the case, particularly if we start to see Fed tapering. I think these bond proxy type stocks, some of the expensive defensives and the high yielding names that have performed well for a very long time now, will start to underperform. That process has started, and I think it will continue. And some of the more cyclical parts of the market, which are geared into continued economic recovery, will do better.
So what are some of the top cyclical stories or sectors that you like?
Well, the most obvious way to play them is actually via the banks. They're by far the cheapest parts of the market outside the US. They are amongst the most exposed stocks to domestic cyclicality. So that's our preferred play at the moment. You need to be a little bit careful within cyclicals, because given what I've said about commodity prices, I don't think you're going to see an improvement in mining capex In fact, I suspect it will go the other way. And that has been a big driver for many industrial cyclicals over the last 10 years or so.
But what about autos? What about real estate? Some of the other names, capital goods, engineering companies?
So I'd steer a little bit away from capital goods, where you have that issue of exposure to mining, and towards some of the more consumer-facing cyclical stocks. So whether it's autos, to your point, airlines, hotels, advertising, media, those kinds of companies.
Okay, for India specifically, are there any particular themes, since you're studying the market very closely right now from an investment perspective, are there any themes that are coming to on your radar or coming to your mind?
I think everyone right now is just focused on the election and find it difficult to look beyond that.
Do you think 2014 could be a year where we actually see an inflection point, so to speak, for global equities?
I think it's odd that despite the fact markets have been rallying for 4 years now, no one seems to feel very good about equity markets. And I really think they should do. And I'd hope that 2014 will be a year of the return of the equity, when we start to see significant inflows into equities as an asset class, which is still yet to happen.
But in terms of returns, do you think that equity markets would perform from here?
I do. I think we can easily see high single-digit, low double-digit returns for 2014 as a whole.
All right, Nick, we leave it at that. Thanks
Thank you
very much for joining us and giving us your views. With that, we come to the end of this edition of Global Mantra Outlook 2014. Thanks very much for watching the show.